Many first-time homebuyers make costly mistakes before they purchase their first home. I'm gonna make sure you know the proper steps to take when looking to purchase a home so that you don't make those same mistakes. Make sure to subscribe for more videos like this one and the home buying process. So we're gonna talk about budget breakdown, researching lenders and mortgage options, getting pre-approved, finding a real estate agent, the home inspection and appraisal, underwriting, closing, and how to save money on your property taxes with the homestead exemption process. So let's talk about budget breakdown. Now there's two different things you want to consider here. There's your budget and what you're comfortable paying on a monthly basis, and there's what the lender would consider your approvable budget for the purchase. They're not always going to align. When I speak to buyers who are looking to purchase, I always like to ask them, how much are you comfortable paying on a monthly basis? Because the thing is, I only know the debt that shows up on your credit report, but we know that's not real life. We know you have other expenses such as groceries, gas for your car, insurance, things that wouldn't appear on a credit report and therefore aren't factored in to our numbers on the lender side. Also, you take home your income after taxes are deducted, but we as a lender qualify you off of your gross income, which is your income prior to taxes and other deductions, which means that what we can qualify you for in most cases will be greater than what you are comfortable paying based on your actual budget. So things you want to look at when budgeting are, one, your housing expense, right? That's going to be the mortgage, the taxes on the prospective property, the insurance on that property, how much money you want to set aside for utilities, right? Your electric, your water, your cable, the maintenance costs. We know that now if you're converting from being a renter and buying a home, now you're responsible for maintaining that property. That could be lawn maintenance. It could be general upkeep and repairs that are needed to a home. We all know no matter how new a home or property is, there's always going to be something that needs to be handled. And then of course, the non-housing debts. Those are the things I mentioned, right? They could be also car payments, credit cards, student loans, things that you have on top of the housing payment naturally, right? There are other expenses you likely are going to incur on a monthly basis. So you need to put together your own budget. And from there, you can determine what you are comfortable paying. Now, from a lender side of things, we are going to look at your debt to income ratio. What is a debt to income ratio? It is your monthly debt compared to your monthly income, debt to income, right? And lenders are going to look at your gross monthly income, as I mentioned, and the debts that we are going to look at are going to be those that appear on your credit report, plus the new proposed housing payment. So whatever that housing payment may be for the property you're looking to qualify for will be added to your other monthly debts on the credit report, and that will be divided into your monthly income to determine your debt to income ratio. Now, the ideal debt to income ratio for most banks and lenders is 45% or less. However, that's not set in stone. On conventional mortgages, you can actually go as high as 50%, and for FHA, it's as high as 57% of your gross monthly income. So let's just say you had income of $6,000 per month and your monthly debt is $2,000. 2,000 divided into 6,000 is 33.33, which means you're at a 33.33% debt to income ratio, which is below these maximums and is definitely below the ideal of 45% that I mentioned. Now, the next thing you want to do after determining a budget is find a lender that's going to best fit your needs. Now, of course, you're going to look at things like the rates they're offering, naturally, their charges, of course. And I get into a bigger breakdown on these things in my other videos if you want to subscribe or comment below, but I give a detailed breakdown of all costs that you'll incur with the home buying process and how to compare lenders effectively and easily. So make sure to check that video out. Like I said, subscribe or comment below. I follow those comments regularly and I will reply to you. But you want to research lenders when you're trying to determine who you want to work with. You can do that on things, you can go as simple as Google searching. You can go on Zillow.com and you can actually search mortgage lenders on there. You can read reviews from past clients. And the nice thing about Zillow, for example, is that the lenders don't determine the reviews that show up on Zillow, because we as lenders don't own Zillow. So you'll have good reviews, you'll have bad reviews. The most important thing is it's transparent, right? So that's a good way to help compare lenders without actually speaking to each one. You can go through, you can see who you think would best suit your needs and goals as a home buyer, and reach out to the ones that you feel fit your needs and suit you best. Now, you also are going to want to determine what type of lender you want to work with, not just based on their reviews, but are you trying to work with a big bank, right? Your typical Bank of America, Wells Fargo, Chase. You know, you walk in, they're a brick and mortar bank, you know them by name. That's why most people do work with them. However, when you work with a bank, you typically have limited hours that the bank is going to be open, and you're not usually going to get the same person on the phone every single time when you need to discuss your loan options or your specific loan. So it depends on what's important to you. Now, you can work with a mortgage broker. A mortgage broker is typically an individual who has access to multiple lenders. They're going to be independent. Really, most aren't linked up with one specific company, and they'll shop some options around for you and go ahead and try to find the best one for you. Now, the downside of a mortgage broker, I'm not going to say in all cases, but in most cases, is they're a one-man show, right? Or one-woman show. So it's just not going to be the same as working with a large company that has different pieces of the process broken down and has different individuals handling those steps of the process in order to make it more efficient, I guess is the best way to put it. One person can only do so much. Then you're going to have retail lenders. A retail lender is going to not be a bank, but they're going to be a mortgage lender only. They're a mortgage bank. They don't do your traditional checking, savings, or anything like that. They only offer mortgage loans. And the reason I say retail is because the alternative would be wholesale. Now, I personally am a wholesale lender. A wholesale lender is someone's able to offer lower rates, lower costs by accessing lenders from, since the backside, and providing more loans to those lenders, therefore getting discounts on those loans, which are passed through to the consumer. A retail lender doesn't do that. They're the one home for those loans, and because they're controlling everything and they have multiple levels of management involved in the retail lending, their rates tend to be a little bit higher, and that's the primary difference. It's like, don't know if you do this, but it's like shopping at a regular grocery store. Here in Florida, we have Publix, versus going shopping at a wholesale store like a Costco. You go to Publix, you're buying one item, you're paying more for that one item because you're only buying one of that item. Publix is a retail store. You go to Costco, we jokingly say, well, why do I need 50 gallons of mayonnaise? I just need the one little tube of mayonnaise. Well, if you're to break that big jar of mayonnaise down to the number of ounces you're getting and the cost per ounce as compared to what you're paying for the mayonnaise at Publix, you're saving money. The reason you're doing it is you're buying in bulk. Same concept. We on the wholesale side of lending deliver our loans in bulk to the investor or the lender and therefore get a discount which is passed through to the consumer. So as I was saying, you need to determine the type of lender. So once you determine who the lender is going to be, you determine the type of lender you want to work with. Then after determining the type of lender you want to work with or the specific lender you want to work with, you need to determine the type of loan you would like to obtain. Now, I've done other videos on the different types of mortgages, the down payments required. Make sure to check those out and subscribe. But the most common type of mortgages that individuals will obtain when they're buying a home are conventional, FHA, VA, or jumbo. Now, conventional mortgages are available on primary residences, second homes, or investment properties. FHA mortgages are only available on primary homes. VA mortgages only available on primary homes and only available to active duty military veterans, or the widow or widower of a deceased military member. And then you have jumbo loans, which are available on primary homes, secondary homes, and investment properties. What is a jumbo loan? A jumbo loan is any mortgage amount that's greater than the conforming or conventional loan limit for the area where you're looking to buy. Now, conforming loan limits are set every single year by Fannie Mae, and they are going to be based on the area area house price for wherever you're looking to purchase. As of right now in the United States, $750,000 is a max conforming conventional loan amount. That means if you borrow anything more than $750,000, you are getting a jumbo mortgage. Now you've determined the lender you're working with. You determined the type of loan you want. Now you need to get pre-approved for the mortgage, right? So what does that mean? That means that you need to get qualified for the loan. Now, what I always like to say is the first thing you want to do with your lender is discuss your home buying plans with that lender. Not everyone has the same plans or goals with the home buying process. These are things such as, I want to buy in this specific area because there's good schools and my kids are going to be going into elementary school. I want to be by there in this price range, but I only plan to keep that home for maybe 5 to 10 years, right? Just general planning. Talk about your budget. Then you're going to want to complete a loan application with that lender. A loan application is going to be where you talk to the lender about your income, your employment, your assets. It's going to require a credit pull. It can be a soft credit pull or a hard credit pull. Soft means it doesn't impact the score but can't really be used for lending. Hard credit inquiry is going to be, might affect the score slightly. It's going to show up on your credit report that someone inquired for you to obtain credit, but it can be used for the underwriting process on a mortgage. So that's really the difference between the two. But you have some people that decide they're not quite ready for the hard credit pull. They prefer a soft credit pull just to get a good idea of what's on their credit and what their scores are. So soft credit pull can be done at that point in time. But you're going to complete the loan application. After you complete a loan application with the lender that you chose, you're going to gather and provide the necessary documents for the pre-approval to be completed. Now, some lenders do what's called pre-qualifications. A pre-qualification means that you would have stopped right here, right? Step 2, you completed the application, you discussed your income, your assets, your employment, and had credit pulled, but you didn't give documents to support the information you discussed. Most realtors and most home sellers don't want a pre-qualification when you submit an offer. They want a pre-approval because it's a lot stronger and it holds a lot more weight when you're submitting that offer. And the reason it does is because you've provided the documents to support the information you gave to your lender over the phone or in person, however you did your loan application. That's when you provide pay stubs, W-2s, bank statements, tax returns if necessary. All of that's provided to lender. And it's not just provided to them, they review it, right? That's the most important thing. Providing documents is what you're going to do, but the lender's job, what they should be doing, is reviewing that and making sure that everything matches what was discussed. Because there might be information that you provided by phone that unintentionally doesn't match the documents. This comes up most often for self-employed borrowers. And if you want details on why this comes up so often for self-employed borrowers and what lenders are actually looking for when qualifying as self-employed borrower, check out my video on qualifying for a mortgage when you're self-employed and why so many self-employed borrowers are turned down at a higher rate than their W-2 counterparts. However, it's important that we as a lender review the documents that are provided in order to complete the pre-approval. The pre in pre-approval means prior to going out and looking at homes. Something that happens pretty often is you have would-be buyers who go out and start looking at properties prior to getting pre-approved, and once they find a home, they decide that they're going to get pre-approved. And unfortunately, there are times those borrowers don't qualify for a mortgage. Well, they could have found that out prior to going out and looking for a home. So if there was something needed to be addressed prior to finding the right property, there's time to take care of that. Not once they fall in love with a home and are pressed for time to try to resolve any potential issues there might be with qualifying. Now, the pre-approval, as I mentioned, creates confidence and strength. It's going to create confidence from the part of the listing agent and the seller, and it creates strength for you because it shows that all of the due diligence that was necessary to qualify you for the purchase of the home has already been done. It shows that you're on top of your game and it shows that you're gonna have an easy time closing and qualifying for the property if the offer is accepted. Now, the next thing you have to do once you've gotten pre-approved, well, you need to find a real estate agent. Now, some people tell you don't need a realtor to find a property. I disagree with that. You might as well have a buyer's agent helping you. It's something they do every single day, and they typically have access to information about homes that you may not have access to. In a lot of cases, they also have relationships with other agents locally, which can help get your offer accepted when you're in a multiple offer situation, meaning that you and someone else have submitted offers on the same property. So just the same way you found a lender, you can also research realtors. You can go on Zillow, read reviews about the realtors. You can take a referral from your lender who might have a realtor that they work with or realtors that they work with in the area where you're looking to purchase. That would be a best fit for your needs. You also want to discuss your buying criteria with that realtor once you find the right one. The same way you discussed your home buying goals and plans with the lender, you need to do that with the realtor so that they can properly conduct the home search for you, right? You're looking for a specific type of home, most likely, so you want to make sure they know all of that information up front so that they can provide you with what you want to see. You're not just getting bombarded with every property that hits the market. And you're going to discuss the appropriate offer prices with them, and they're going to help you negotiate the terms and contingencies that are going to best suit the offer that you're making. They're going to be the ones that can help you with things such as seller credits discussed in other videos. Make sure to subscribe, and you can learn what seller credits are and how they can benefit you with getting lower interest rates and lower costs when you're buying a home. But that's something that a buyer's agent or realtor will do for you when negotiating the contract that you might not know to do for yourself if you did not have representation. Now, once you're under contract, what happens? Well, the first thing you're going to want to do is have a home inspection done. A home inspection is going to look for deficiencies with the property. Now, I'm not talking about things you might see when you walk into the home, like peeling paint. I'm talking about the underlying issues, the things that really matter. Are there issues with the roof, the plumbing, the electrical system in the home? The home inspector is going to be the one to determine whether or not there are issues with the property. There could be issues that affect the ability to get a mortgage on the property. There could be issues that affect the ability to get insurance on the property. You need to know these things in advance, and that's why in the purchase contract, also another video I've done walking you through the purchase contract and understanding the different sections of that contract. One section of the purchase contract has to do with the inspection period. It's a set amount of time you have to have the home inspection conducted and renegotiate the terms of the contract based on the findings of that home inspection. But it's going to look for deficiencies. So what's cool about the home inspection, it's going to find something. No home is perfect. And you can either have the seller cure those deficiencies, meaning take care of them on their own, hire someone to handle it, or it's a good time to renegotiate the terms, such as requesting a seller credit. Once again, watch my video on seller credits and how to utilize them toward your home purchase. Next, you're gonna have an appraisal done, assuming you make it past the inspection period. You work things out with the seller. The appraisal is ordered by the lender. What makes an appraisal different than an inspection? Well, the appraisal helps determine the market value of the property. The inspection has nothing to do with the value of the property. It has to do with the condition of the property. The appraisal, on the other hand, is going to help determine the value. So you've agreed upon a purchase price. Is the home actually worth that based on information that's available in the market? The thing that supports a value or doesn't support a value most often is going to be the most recent comparable sales. So homes that are like the one you're buying that have sold within the last 6 months, typically within a 1 mile radius of the home. Then, if you have a bad inspection or a low appraisal, once again, that's when you can use those things as a tool to renegotiate the terms of the contract. Ask for seller credits, ask for a reduced purchase price. But this, once again, is where your buyer's agent comes into play, especially if you're buying your first home. You want that realtor by your side to get you through these steps of the process because they're going to help you get the best possible terms negotiated into your contract. Closing time. You've made it past the inspection. You've made it past the appraisal. Your loan's been approved. What's next? Well, you're gonna do a final walkthrough with your realtor. It's usually done the day before or the morning of your closing to make sure the property is still in the same state that it was physically when you went and looked at it and negotiated to go under contract on the property. Because by this point, the seller should have moved all of their furniture out of the property, and you want to make sure that nothing was broken, no walls were damaged, no doors were damaged, floor was damaged, right? You want to be able to see everything without the furniture and make sure everything is exactly as you expected to receive the home. Then you'll wire the remaining funds needed for the closing to the title company or title attorney that's handling the closing. At closing, you're going to review all of the documents, make sure that the terms are exactly what you agreed to at the beginning of the process or when you last negotiated the terms of the contract, and you're going to sign. And after that, guess what? You're going to celebrate being a homeowner. You've got your keys, you're moving in, and you have many future memories to make in that home. Now, what happens once you own that home? Well, now you're responsible for everything. And one of the things you're responsible for are the property taxes on that home. But how do you save money on the property taxes? Well, it's a great question. That's where the homestead process comes into play. So if you're buying a property as your primary residence, meaning you're going to live there year round, here in Florida, for example, you can file for what's known as a homestead exemption. This means you're claiming the property as your primary residence. What this does for you is it reduces the taxable value of the property, and in turn, it's going to save you money on your property tax bill. And you need to understand that benefit because it's huge. Here's how it works. So the county's going to come in and they're going to assess the value of your property. I'm not talking about the home appraiser. I'm talking about now the county tax appraiser. And let's say they determine that to be $400,000. That's your tax assessed value. But you filed for your homestead exemption and you're a married couple. So you get a roughly $50,000 reduction in that assessed value of the home, which means your taxable value is what's left. It's $350,000, $400,000 minus $50,000. Now, if you're at a 2% tax rate on that property, 2% of $50,000 is $1,000 per year that you'd be saving just by having a homestead exemption on the property. It's as simple as going onto the county website, filling out the sheet and providing the necessary documents to receive this exemption, link below in the description. But it's really, really simple to have pretty significant savings. If you were to keep this property 20 years, that means you're saving $20,000 over 20 years in property taxes, money you'd never get back. So if you were to keep the property for 20 years, you're going to save $20,000 in property taxes over that 20-year period. So for more tips like this one and videos talking about more topics pertaining to home ownership, make sure to subscribe. If you have specific questions for me, comment below. I read those comments regularly and will respond.